Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello and welcome to State of the Economy podcast by Business Line, where we discuss the real estate trends of the month gone by and the upcoming trends and outlook. We have with us Mr. Ashish Khandelia, the founder of Certus Capital. Welcome to Business Line podcast, sir.
Thank you. Thank you, Abhishek.
Mr. Ashish has over 20 years of experience with expertise in real estate investing and lending. In his earlier roles, he had led the real estate businesses at KKR and Morgan Stanley Real Estate in India. He has US dollar 1.9 billion worth of transactions experience and has been instrumental in building 3 businesses around real estate, banking, equity investing, and lending. He founded Certus Capital in July 2018, and since then, Certus Capital is an independent, team-owned firm that partners institutional investors and family offices to invest in real estate opportunities in India.
Thank you. Thank you so much, Abhishek, for that introduction, and look forward to this discussion.
The first question, sir, obviously, how has the private credit market in India played out, let's say, over the last few years, post-COVID? If we take a 5-year time frame, and could you put some numbers on board for us?
So I think the advent of private credit market, especially at a broader level, has gained more popularity over the last 2.5 years. But it really started seeing a lot of activity after the IL&FS crisis in 2018. Because IL&FS crisis in 2018, September 2018, was almost like a mini GFC, or global financial crisis of 2008, an event similar to that for India. And it actually brought a lot of pressure, liquidity pressure, and asset quality pressure onto the domestic system. So for a period of time, most of that void was really filled by foreign institutional investors. These were credit funds, special situation funds, and all that kind of stepped in. So a lot of that activity happened in 2019, where you would have also seen some of the erstwhile financial institutions that included the likes of DHFL, Altico, Yes Bank, one of the outfits of Reliance Capital. A lot of these went down, and a lot of these portfolios came into play. So I think that kind of caused this thing. And I think over the last 3-4 years, the domestic fund managers, domestic wealth, domestic HNIs, and family offices have also become a lot more aware of this kind of an opportunity. And today, both foreign investors and domestic investors are kind of going after it. I mean, if I were to put some numbers on board, I think over the course of last 4-5 years, I don't have the exact numbers, but it would be probably north of $15 billion at least, probably more, because just over the last 1.5 years, I think based on certain estimates that have been done by EY, I think it is really close to $9 billion. I mean, $5 billion happened in 2022, and just this first half, we have seen close to $4 billion of private credit investments happening. And within this, I think real estate continues to be a very large space. Like, for example, last year in 2022, about 30% plus ended up being real estate private, the share of real estate private credit at about $1.6 billion.
Okay, right. And sir, if I look at the current scenario, it's a very upcycle the real estate market is witnessing in India. Is there any demand outlook or picture for the next few quarters, maybe a year, 2 years, some period?
I mean, see, I think, yes, you're right. There has been a very significant turnaround in the sector starting from the end of COVID, which was in 2021. And like 2022 was one of the most robust years in about 10 years, where we sold about close to 4.5 lakh units. Right. And first quarter of this financial year, also just tier 1 cities have sold more than 1.1 lakh units. So I think basically a very, very robust trend, and this kind of continues. So our expectation is that these healthy levels will be maintained over at least next 3 to 4 years. I mean, it is just driven by the fact that basically from an affordability point of view, we are at the rock bottom. I mean, we are at a 20-year low in terms of affordability, or it is thereabouts that, because there has been significant increase in salaries and compensations and all that over the last 7, 8 years. But but basically the CAGR, or a compounded annual growth rate in housing prices, that have been a minuscule 2 to 3%. And there are enough and more pockets which have been stagnant. So affordability is very high. Mortgage penetration is still low. And mortgage rates, despite their increase of about 2 odd % from their lows of 6.5%, are still quite reasonable at 8.5 about percent. So our opinion is that next 3 to 4 years should remain fairly robust. And the quality of the supply is also much better because it is coming from more disciplined players under a more regulated environment now after ERA.
Right. And since we spoke of mortgage rates or bank rates, how do you see that having an impact on demand? There were some hikes. Did it slow down demand temporarily? Now that it's stable, what is the outlook again?
I don't
I
think
mean,
there
you
was
can
any.
never rule out a rate hike option.
Yeah. Yeah, you can't really, because globally, I think most central banks are still kind of hawkish. I think they're watching inflation quite closely, which has not cooled down. It has come off, but it has not cooled down to the to their desired levels. In India, also food inflation continues to remain high. So to that extent, RBI is also doing a fairly balanced act in terms of their actions and commentary. So you can't totally rule it out, but I think India is, in that sense, on a much better wicket as we speak. And while the rates went up, they went up by about 2% plus. But to be honest, I think they went up from a very low base. India has never seen home loan rates in the range of 6.25, 6.5%. That was very low. And when they're back at 8.5%, that's where I think rates have more normally been. So if they start crossing 9% and all that is when we have to worry. But I think we have already gone through a rate hike cycle, and if it has not finished, I think most of it is done. So we're not very worried about significant increase in mortgage rates from where we are right now. And this 2% increase that we witnessed over the last 1.5 odd years, that has actually not impacted demand in any meaningful way. In fact, the demand has remained very robust. So purely on the rate action point of view, I don't think there is much of a worry about they spoiling the party.
Right. And in the private credit segment where you play out also, what kind of opportunities do you see in the near term, let's say the immediate 1 year?
Yeah, so I mean the private credit segment opportunities had been evolving. I mean, initially they were mostly on the distressed stress asset kind of side, where we had either stuck projects or situations which has run out of working capital requirements, or projects have become NP and all that. And there continues to be a certain segment of those kind of opportunities that still exist, which we call them more like stressed assets or special situation kind of opportunities. But I think there are also two other large segment of opportunities that are there. One is just pure growth opportunity. So with this strong rebound in the markets, a lot of quality and credible players, they are looking at new growth, new acquisitions, new project acquisitions, and so on and so forth. And therefore, there is basically an opportunity on the growth capital side. We have participated in a couple such situations. Then at the same time, there is a huge void that has been left by erstwhile financiers who are no more active or relevant anymore, right? Or basically a lot of wholesale NBFC business that used to happen, that has become stagnant or being curtailed down. So there is this void that has been left by erstwhile lenders, non-bank finance companies especially, which needs to be filled now, right? And that is where I think new age companies like ourselves or alternative investment funds or private credit funds are stepping in and filling in that gap. This could be of anything. Sometimes it is construction finance, sometimes it's a mix of exiting the existing lender who is no more really active and is liquidating their portfolio and taking over those positions and providing further growth capital and so on and so forth. And there continues to be these special situation kind of opportunities where now the projects may have actually become quite advanced stage, but they're stuck for one reason or the other, and need some new financing solutions to step in and lead them to completion.
And these demand or these new growth areas that you see that you just spoke of are coming typically from which sort of geographies in India? Can you name some of these geographies?
I think, to be honest, they're across the board and across subsegments. I mean, my core area of specialization is real estate, so that's what I'm gonna kind of really talk about. But we are seeing this across all the major cities in India. To give you an example, I think Mumbai saw one of the highest registrations ever at 10,000 plus units in August, right? It continues to perform very well. I mean, Bangalore residential markets are performing very well, and we are seeing a lot of growth opportunities coming from there, both for typical residential development, plotted development, etc. Right? Hyderabad has seen a very significant re-rating almost of the market, and in fact, that is one market which you want to watch a little bit cautiously. NCR has seen significant increase in prices. That is where the prices have gone up actually most significantly. So, I mean, these are just few data points for you to kind of get a sense that across geographies, there is a fair amount of energy, in growth. And what we kind of hear is that even tier two cities, are showing a decent amount of momentum. So that's kind of on the residential side where we do see a lot of growth. Apart from that, other segments of real estate, whether it is warehousing, whether it is data centers, they had also been seeing a lot of growth. I mean, there are so many large land acquisition deals that have been announced on the data center sides, and then there are people who are now putting together specific pools to tap into that opportunity. So across subsectors and across geographies, we are seeing this growth.
And beyond private credit, one interesting area has been family offices of investors. I mean, there have been a lot of family offices which have shown interest in investing in real estate. What is the status there? Can you just give us a brief picture? What is driving these demand?
Yes, yeah, I think family offices in general are becoming a very, very significant cohort of investors. So historically, a lot of capital flows or large segment of capital flows really used to happen from offshore by foreign investors and all that, right? And the domestic capital, even if its participation was there, that was in more smaller format transactions or in smaller funds and all that. But I think family offices has been on the rise for about a decade. And as we see generational shifts that are happening, there is a significant amount of shift that's happening from a lot of people who build businesses, and now as those founders are kind of hanging up their boots, and the wealth is passing on to the next generation. Many a times, the next generation is actually converting that wealth into family offices, and then these sizes have become very large. Also, Indian businesses have just become very large, and many of these operating businesses and all that, they continue to have now substantial family offices. So this family office as a space over the last 10 years has become a lot more organized. And as it is getting organized, there is more professional management, professional investors that are getting roped in. So when that's kind of happening, there is more channelization of this money into various kind of opportunities that include real estate, that include private credit, and so many other venture capital, and so on and so forth. So that's very clearly is one thing. I mean, to just give you an example, there was this 1,000 odd crore transaction that was done by, I think, the Damani family in 360 West in Bombay, right? That's just the example of one such large trade, which otherwise you will only look at a foreign investor to bring in that kind of a corpus. So that just gives you the weight of family office today, what they can possibly do as a solution or as an investment.
So this brings me to the next part of my, or if I may put it, the phase two of my questioning, which is basically around Certus Capital itself. So where does Certus Capital stand in this scheme of things that we just spoke of? What sort of credit push that you have seen? What sort of growth have you seen in India? Can you share with us some of the projects that you have backed or invested?
So see, I mean, just to add a little bit to the introduction that you gave about Certus Capital. So as you mentioned, we started in 2018. So we are about 5 years old. So basically at Certus Capital, our core expertise has been real estate, but we have been very focused on real estate as a sector, and within real estate, credit as a theme. right? It is also just the fact that as we started immediately after that, we had this event of IL&FS, which created a huge credit vacuum for wholesale lending in general and real estate lending in particular. And that's where we spent actually a lot of our initial 2-3 years, which was after the IL&FS crisis and through COVID. So during that period, we actually worked with a lot of institutional investors. And in this part, we have advised on transactions aggregating to more than 8,000 crores. Most of these transactions had been oriented around either credit or credit platforms, right? A lot of that involved helping erstwhile NBFCs get liquidity against their real estate portfolios, or basically bidding against some real estate portfolios and all that stuff. And as we were kind of coming out of COVID and this whole sector was bouncing back, I mean, one of the thought process, which was always the original thought process with which I had left KKR, was to kind of create a platform that will channelize domestic capital into real estate. Because, I think in real estate, and basically if we look at a 7-year cycle, we need almost $100 billion of developmental capital. And most of the foreign capital that comes in real estate, that has to date, despite it now having almost close to a 20-year history, to date has mostly 80% plus of that has been oriented towards buying assets or supporting build out of assets as opposed to developmental capital. That is where most of India is. India residential is the largest segment, requiring close to 500 million square feet per annum. Right. So the whole idea was, can we channelize domestic capital towards this growth story? And that's kind of what we started doing with Earnest.me last year, which is actually a platform wherein we bring in all this institutional expertise. And using this institutional expertise, we create credit opportunities within the real estate sector, which in a bit more democratized way can be accessed by a lot of investors. So that's what we had been kind of doing. Earnest.me is a relatively new platform, started about just over a year ago. So there we have invested in 4 projects till now, two in Bombay, one in Chennai, one in Pune. And now we are looking at 4-5 more across these tier 1 cities.
Right. And in terms of return on investments, what sort of return of investments have you obtained over these, let's say, 5-year period for Certus and Earnest.me?
So I think so on the transaction that we advised on, and I must say these are transactions that we were advisors to, not necessarily investors in there, but most of the transactions that we advised investors on these transactions had returns that ranged anywhere between 19 to 23%, and in most cases on a senior secured credit basis. Right, a lot of performing credit. So, but these were all special situation opportunities that needed some solving, etc., etc. A lot of performing credit that we had been doing for Earnest.me. I think the return that we had been able to offer to our investors, again on a senior secured basis, and this is all on performing projects which are doing well, have no kind of stress or anything of that sort. That return has ranged anywhere between 15 to 16%. So the broad bucket of range in which we end up operating ends up being somewhere around 14% all the way upwards to about 20%.
Right. And do you make your own investments? How much have they generated returns to around?
That's right. So on the Earnest.me platform is where we are actually making our own principal investments, and
that's right.
And that's where I think the return range that we have so far targeted is 15 to 16%.
Right. And you happy with that, or you want to take that up now? I mean, obviously anyone wants to take that up, but what's the general target there?
No, see, honestly, I think it's not a question of wanting to take it up or down, really speaking. It's really a question of what is the underlying risk that you are looking at, what should be the appropriate return for that investment, and what is the investor category that you are catering to, right? To be honest, I think if you are catering to an investor segment that is very risk averse and basically simple standard transactions which pay interest on a quarter basis, does not have a duration of more than 2.5 to 3.5 years, generally speaking, we would want to stick to this 15% plus minus kind of a return range, because that's the appropriate return for the kind of risk I'm talking about, right? And enough and more people are very happy with that levels because it is still about more than 2x the typical return that they can make on a FT or a bond or a debt mutual fund, right? So and the transparency with which it has been done using the technology and the platform underlying it is what is really kind of differentiating the way this opportunity is being made available to them versus what has been the erstwhile experience, right? So that's kind of one segment. Where we have started stepping up a little bit also is the nature of work that we have been doing with institutions, right? Foreign institutions, which is more in the special sits category. Now, with a certain segment of investors, and we may launch an AIF for that. We already have a license in place for that. Is where you may take a little bit more special sit oriented kind of opportunistic investments, and that will be more in the high teens to early 20s. So, but that is a slightly different investor segment.
And just for our listeners, can you just quickly elaborate on just one line maybe on what is this? So AIF.
AIF is just basically your alternative investment funds, the SEBI regime under which any of the domestic managers can manage funds, right? In which you are basically committing a minimum of 1 crore and upwards, right? And these are locked in structures. So once you commit, I mean, generally your fund has a life of anywhere between 5 to 7 years. So that allows investors to take a bit more long-termish view about the kind of opportunities that will come under an alternative investment for an AIF, right? And also it just ensures that that basically investors have enough and more sophistication to understand that risk, and that's how they are then looking to participate in this AIF.
Right. And my last question for the day as of would be, sir, so where do you see your business over the next 5 years? What sort of growth plans do you have? I know we have been discussing all of this all through, but if you can quickly sum it up in a 5-year plan.
Yeah, so I think so the way, honestly, the way we look at it is 2-3 aspects. At a broader level, what we are really, really wanting to do is participate in this whole alternative bond or debt capital market creation in the country. So what I mean by that is, if you go back 20-25 years ago, there's this whole equity revolution that started. Effectively, advent of mutual funds basically democratize investing into equities, right? Before that, it will happen in a very hodgepodge manner. People will act on tips or whatever, hearsay and all that, without having any professional expertise. But with the advent of mutual fund, that whole thing changed. And today, I mean, we are still at the tip of the iceberg when it comes to participation, but it has become a very large industry. I think the same thing is starting to happen with debt or fixed income products, right? And we are at the cusp of starting that thing. So we are very keen to participate in that journey. I mean, real estate private credit is at a good place right now, and incidentally our expertise also. So we are using that route. But over the 5-year period, we want to evolve into a credit platform, which is not serving only real estate, but maybe some other aspects. We would look at least participating into 4,000 to 5,000 crore of credit investments on a per annum basis by that period of time. And we do believe that India as such easily offer that much potential. Even if I look at just 2-3 core segments that include real estate, infrastructure, and other yielding assets. So that's kind of how we are really looking at the growth of Certus Capital and earnest earnings.
That was Mr. Ashish Khandelia for you all, and thank you once again, sir, for being on Business Line Podcast. Thank you so much for taking out time.
So thank you so much, Abhishek. It was an interesting conversation. Thank you for having me here today.